We expect growth for the Indian economy to be at 6% in fiscal year 2026, which is April 25 to March 26, compared to 6.5% in FY25. This suggests a slowdown because although India is resilient to tariff troubles compared to regional economies, it is not immune. The channels of impact will likely be investment spending and exports, which we expect will moderate in FY26 compared to FY25. Our FY26 growth forecast of 6%, notwithstanding the statistical idiosyncrasies associated with net taxes, reflects a stabilization in household spending at about 6% as well, compared to 7.2% in FY25. This reflects consumption spending remaining relatively subdued in the first half of the fiscal year before picking up in the second half as looser monetary policies, better intermediation and higher credit growth support spending. We expect that fiscal consolidation will continue, underpinned by strong prospects of GST revenue collections and the simplification of tariff structures through the rationalization of custom tariffs. On the expenditure front, we expect expenditure growth to remain in check. And even if there is a need for some growth support on account of external factors, we expect it to be more targeted rather than broad-based to reduce the fiscal burden. This will likely keep government spending in check at about 3.5% in FY26 compared to 2.3% in FY25. Indeed, recent developments on the fiscal front have been encouraging. The government achieved its revised fiscal deficit target of 4.8% of GDP in FY25 and aims to further reduce the deficit to 4.4% in the coming fiscal year. Revenues grew by around 11.3% in FY25 compared to 14.5% in FY24, while expenditure growth slowed to 6% from 10.5% in FY24. Importantly, Capex remained strong at 28.3% from 24.8% in FY24. At 6% growth, this allows for a relatively resilient growth profile in the near term. And over the medium term, the Indian government is working to diversify trade and investment partnerships. For example, India and the UK recently signed a bilateral trade agreement in May 2025. This agreement is expected to increase trade between the two countries by 34 billion a year from 2040. The agreement will cut levies on 90% of British products sold in India, while 99% of India's exports to the UK will face no duties. The deal also contains a double contribution convention which will exempt temporary Indian workers in Britain and their employers from making social security contributions in Britain for 3 years. In addition, UK businesses will have access to India's procurement market covering goods, services and construction. Meanwhile, inflationary pressures have eased considerably over the past 6 months on account of lower food and transportation prices. Food inflation eased from a peak of 10.9% in October 24 to 1.8% in April 25, driven by pulses and vegetable prices. This more than offsets some modest increases in fuel inflation, and core inflation remains subdued. However, headline inflation averaged a lower 4.6% in FY25 from 5.4% in FY24. For FY26, we have reduced our headline inflation forecast to 3.8% from 4.3%, and this is broadly consistent with the RBI's revised forecast of 3.7%. The Reserve Bank of India did cut its policy rate by a bigger than expected 50 basis points at its 6 June meeting, taking the repo rate to 5.5%. This is a cumulative 100 basis points in rate cuts from February through to June 2025. The RBI did revert to a neutral stance after shifting to an accommodative one in April. We do, however, expect the RBI to cut its policy rate by an additional 50 basis points, taking the policy rate to 5% by December 2025. The risk, however, is that RBI saves these bullets for later should a growth slowdown next year become more pronounced.